Hi there, everybody. This is Jenny Clark with Solvability, and we've got another session of Freedom Friday. Today's session is sponsored by Bassbury and Sims, my favorite law firm. And we've got Jason Northcutt here today to talk to us about the merger and acquisition activity in government contracting. So when we started talking before this, Jason and I said, what do people want to know? And I said, most of the companies we're talking to are smaller companies, but they want to know where they're going to be able to go in the future. And they're looking for Jason to give us some insight on what's been going on in the M&A market and really kind of how to be positioning themselves. And for me, I called it, what are the elements of value? So Jason, how about you just take it away? And by the way, you may want to tell people a little bit about Jason and what you do as well.
Yep, happy. Good afternoon, everyone. Again, my name is Jason Northcutt. I'm a partner, corporate partner at Bassbury and Sims. We are about 300 lawyers spread across Memphis, Nashville, Knoxville, and I'm here in DC. So most of my practice is in M&A. All my practice is in mergers and acquisitions, and by far the biggest industry has been government contractors. I think we represent companies of all shapes and sizes in the space. From we've done deals of $2 billion all the way down to a couple $1 million. So we're all over the sandbox, as they say. So we can make most deals that parties want to happen. We can help in some regard in almost anything. In terms of what's going on in the value drivers, I mean, there was a definite slowdown in the middle of the year across M&A. I think there was a couple of reasons for that, all due to COVID. I think some of it was just tactical, in that people were sort of not traveling. It was hard for deals that were not already in place. It was hard for them to get off the ground. People couldn't go meet each other. Do their site inspections, meet eye to eye. All the initial steps that usually have to happen at the outset of a deal just weren't happening. I think even strategically, there was some arbitrage of attention span that CEOs and leaders of company were trying to spend time just managing through the process of dealing with the remote work and working from home, and trying to do right by customers and employees, and sort of putting more strategic decisions, M&A sort of on the back burner. As the summer sort of rolled through to August, September, we've seen pretty sizable uptick in activity again. I think people are sort of adapting to the new normal and are comfortable doing a deal virtually from beginning to end. And so I've done several deals where it was just done almost completely through Zoom or Microsoft Teams.
Oh my gosh. And Jason, I can't imagine having to try to coordinate all those parties, because I'm used to watching the movies where they all go into the boardroom and everybody's perfectly prepared with a straight thing, and they're all saying, okay, all you have to do is sign this piece of paper. Is that what it looks like?
No, it's even pre-COVID, that's not how deals have unfolded. I mean, in general, you sort of have the early stages where the principals or if they have a banker will meet face to face, sort of come to an agreement in principle, letter of intent or a term sheet of some sort. But most of the back and forth of the documents and even the closings are happening through email and virtual exchange of documents. So it was really more of the face-to-face principal-to-principal meetings. That step was really cut short by the pandemic. I haven't done sort of a live closing around a conference table. I mean, that was typical the first 2-3 years of my career, which was 20 years ago. So 2001, 2002, that was pretty common. Since then, everything's been done by exchange of email documents for the most part.
Well, that's a relief, because it just seems like that's what you visualize is what it's like to put together a big deal. But one of the things you also mentioned was kind of what are the factors of value of these companies? What do they have to, if I'm thinking about, I've got a government contracting business now, and I want to be intentional because that's what Russ Barnes always tells me to do. What do I need to be thinking about in terms of exit strategy so that I can beef up that value as high as possible?
Yeah, great question, Jenny. I think there are a number of factors that drive valuation in the space. I mean, I think your prime sub mix. The more prime work you have, generally the better, because you have more control over the work and how much you're doing or not doing. I think your small business / 8A contract mix is pretty vital. 8A, frankly, it can, if you have a lot of 8A contracts, it can be hard to sell your business just because of the requirement for the government to issue a waiver. When there's a change of control for that work to continue. Small, you'll often see, some valuation discount compared to sort of, full and open. But, a lot of the small business stuff, can often be structured around because, oftentimes in those contracts, it's really more up to the government whether or not they terminate it. There's sort of no mandate to go get a waiver. It's, the work can often continue. The government just can no longer count that, small, when the company's no longer small, can't count it towards its small business quota. And so, it still has the ability to go fill its small business quota through other vehicles or other work, or et cetera, et cetera. Depending again on how differentiated, the product or service is. I think one of the other big drivers is, how commoditized or secret sauce your offering is. The more differentiated it is, if you're doing super classified work or something that's perceived as really high value add or mission critical, a lot of especially the small business contracts, it's easier to manage around it, and you typically drive a higher valuation with those. The other things are customer concentration. So if you have, if you're doing a lot of work for just, one office or, small number of offices, and it's all your work is tied up into a relatively small number of contracts, that's riskier for a buyer. And then you sort of get into diligence profile issues, how your CPARs looked. Do you have the past performance that a buyer might be looking for to go win, bigger vehicles, those kinds of issues.
Well, I think what you're talking about is really important. And the other thing that always comes up is, how big does a company need to be sellable? And it sounded like you had a lot of options, because you mentioned something called private equity, which I didn't realize there was more buying in private equity than there would have been acquisitions from largers. Can you talk a little bit about what private equity is first, and then kind of explain some more?
Yeah. So private equity is basically just a fund, an investment fund for usually institutional investors, pension funds or insurance companies or whatever, to get sort of non-public company returns. They structure their investments. A lot of them focus on specific industries or business models, and they will leverage their acquisition. They'll go buy a company with, call it 30 or one third equity and then debt for the other 2/3. And their plan is to grow the business and use that debt to really leverage their equity returns. 30 years ago, late 80s, early 90s, sort of as private equity hit the mainstream, coming out of the 80s, Carlyle was sort of the one big PE shop, here in DC, and they were sort of the one that looked at government contracts, and they built a number of huge platforms and were super well connected. Throughout the 90s, there were a few more, I think Veritas and Arlington and a few others. Now there are probably several dozen, ranging from, you still have Veritas with, several 10 billion or so, and Carlyle of even bigger than that, down to your, funds of 100 or 200 million dollars each that are looking for acquisitions. They're doing 10, 20, 30 million dollar acquisitions of companies. And they do, what they call a buy and build strategy, where they find these fragmented industries, fragmented companies in a space, build them together and try to come up with some synergies on the revenue side, on the cost side, to make the sum, more, the whole worth more than the sum of the parts. And they build it up to, a critical mass. They get that company to $200 million. And then it looks attractive to somebody like Raytheon or Lockheed Martin. It could be quite difficult for a 10 or $20 million company to get on the radar of, a company with a $50 billion market capitalization, just because, that deal doesn't move the needle, for Lockheed Martin or Northrop Grumman or somebody like that. Adding $10 million to the revenue and, $2 million in EBITDA is really just not worth their time for the most part, unless there is some mission critical, contract or super relationship there that they find strategic value in. You sort of need to get into, I would think you probably need 9 digits to sort of start getting the radars of the big tier ones. That said, there are plenty of middle tier companies, that are private equity backed, that look at small companies as add-ons all the time. I think I said at the beginning, our group has done deals as small as, $2, $3, $4, $5 million, where it made strategic sense, where there was a good contract mix, relationships that a bigger company wanted. So they do happen. But yeah, I think, and I wouldn't want to say that private equity still does more deals. There are obviously far more strategic buyers than private equity. It's just that they have done a lot. Their level of deal activity in the space has increased a lot over the past 15, 20 years, compared to strategics, where they used to have one big competitor in private equity, Carlyle. Now there are, dozens.
Well, I'm really glad you're explaining this to me, because I remember going out to lunch with a private equity guy in Tampa Bay. And even though I have a financial background, I really didn't understand what it was, because I said, "You mean venture capital?" He said, No, that's not what it is.
Yeah.
And he explained to me how private equity can be structured, the deals differently. And he gave me an example, and I don't know if I got this right, but where you had an owner that wanted to get out, have some money to retire, but that was still willing to stay involved in the company for 4 or 5 years. But it was almost like giving cash back. And I don't want you to have to go into too much detail, but could you give me some examples that would explain that better?
Yeah, that's absolutely right. So that's actually one of the defining features of private equity, in my experience, is basically the selling owner will get sort of 2 bites at the apple. So to use the gambling analogy, they can take some chips off the table for the company they've built from scratch, monetize, call it 75, 80%, of their ownership in exchange for cash. But they would keep generally, a sizable, call it 10 to 30% rollover equity is what we call it typically, in the new business. Usually they would stay on as CEO. The private equity guys they're smart, but they're usually financial engineers. They're not operations guys. They would sit on the board. They'd help provide strategic advice, but generally management stays in place, by and large, and PE firms rely heavily on the management and heavily incentivize them to meet performance targets. So in addition to the rollover stock, you're usually looking at, performance targets, performance bonuses, additional upside in the form of options or other, sort of growth equity. So that is sort of one of the, common features. You mentioned venture capital. So the venture capital comes at it from a slightly different perspective, in that, they're injecting new money that's usually used for sort of growth initiatives like research and development. It's not typically used for owners to take money off the table. And it's usually a sort of a minority position that's coming in. So, in a $10 million deal, you might take $2 million of venture capital money, for a $12 million valuation or something.
So that's more like what they do on Shark Tank then, right?
I don't watch Shark Tank, but yeah, probably so.
Okay. Well, I think that makes a lot of sense. The other thing I've seen with a lot of the companies that are in federal contractor that I've seen to be successful is it starts with 2 partner founders. Usually one of the founders is the idea and the salesperson, and the other one's the operations. And you can operate very successfully with that growth because then you know all your options are covered with somebody that you really trust. But what I've also questioned sometimes is, especially if there's an older, the entrepreneur, there's an age gap. It's really hard to figure out how they would sell out of their company because they have different goals. Because if I'm 65, my goal and my 40-year-old partner, totally different goals on where we want to go. And this is probably not a great example, but how do you get the team at the company to understand what you're going to do and how it's going to benefit each one of them? Because don't they a lot of times have hidden agendas in a way? They don't want to tell you what they really want.
Yeah, I mean, well, it's certainly the case, especially in small, closely held businesses. There tends to be more personal motivation, sort of emotional connection to the company, than there are in sort of Fortune 500s, which are probably a bit more hard nosed, in terms of monolithic in their approach. So you certainly have personalities to manage throughout the process. I would say, if you're in a business, and you think you may have, diverging interests, you're probably better off, sort of dealing with those going into the relationship in terms of how you deal with it in the stockholders agreement, so that you deal with them up front and how you're going to resolve those, sort of when you're cool and rational, and not sort of after you're already, at odds with each other. You can create things, buy sell rights or drag along rights. So if for instance there's an offer, and a majority shareholder wants to take it, can sort of require other shareholders to participate under certain terms, or be bought out, if they don't want to participate in the sale, at the same price. So I think that's probably the advice we'd give to people sort of going into even thinking about a process is, sort of get your corporate house in order in terms of your governance documents, making sure that your key stakeholders, whether they're owners or employees, are on board with it. You got to be careful about opening up the tent to too many people too soon. But if there are people who are going to be critical for a buyer, whether it's private equity or strategic, you're going to want to make sure that you have them incentivized to stay, until and even through a closing. And you can do that. There's a lot of levers that companies have that do that, whether it's through giving them equity or sale bonuses or transaction bonuses that are payable at closing, or even 6 months after closing. So there are a lot of tools in the toolbox to do that, and each situation is a little bit different depending on the personalities.
Well, I think what you're talking about is really important, because so many of the companies that I talked to, when they did the stockholder agreement, they did it on LegalZoom.
Yeah,
And it's kind of like, when
agreements.
you're married and you don't go, if you didn't have a prenup before you married, to go back and say, could we put one in later, sounds like a problem. And but you also mentioned buy sell. Would you mind defining what buy sell is and give them a little background on that as well?
Yeah, sure. A buy sell, again, they take a lot of forms, but they basically say, under XYZ circumstances, say, death or disability, or God forbid, people just don't get along, the parties can trigger what they call buy sell, so that one party can buy out the other, for the good of the company. So that, hey, listen, we just, the company's suffering because we can't make decisions, we're at odds with each other, we need more of a unified voice. And so you trigger the buy sell in order to, one party buys out the other. And and there are a lot of different forms those can take, but that's the buy sell. It's basically a mechanism for the parties to separate amicably under terms that were negotiated, not under the heat of the moment, but at the beginning of the relationship, when people were sort of cool and rational about it.
And can it also be set up to cover the death of one of the owners? Isn't it like you get it backed by life insurance or something?
That's right. Yeah. So, I mean, death, disability. So, yeah, I mean, often, it'll be triggered on, and it's really more of an estate planning issue, but, if partner A, terminally ill or is in an accident and dies, oftentimes it's the case that a substantial part of their net worth is tied up in this private company. And so, the founder or the owner may want there to be some life insurance sort of backing that up to make sure that, the estate has, get some proceeds out of it. and frankly, it's usually better for the company too, because if it goes through the estate and somebody's, nephew who doesn't know anything about the company gets it and starts calling, and now they're a significant minority or even a majority stockholder, that's not a recipe for success.
Well, I've seen a lot of cases where things went south because of uncertainty over that. There was a Huntsville company where I think the three principals all were killed in the same plane crash.
Mm-hmm.
And so it was unclear what would happen. I've had other ones where the principal that founded the company had family members, but the family members weren't quite old enough. And it kind of reminds you of, the story of the bloodlines of Europe, and how come what happened in England happened when it did, and how come France ascended at that point, because it was unclear who was going to take the place next. And when you're excited about starting your company and getting into the market and taking care of your customers and having employees, I'm a real low paperwork person. And sometimes I think, I wonder if I should have done something about that. But luckily, it's like they need to be talking to an attorney periodically just to say, I think I need to update my documents, right? What do you tell them to do?
Yeah. I mean, listen, a lot of times, if you had an attorney put these together and you're happy with it, we don't go in and try to just redo a new stockholders agreement just because we can, right? I mean, we're happy to sort of take a look at things. Like, here's what it says happens. Have you thought about this? Have you thought about that? If so, and this is the way you want it to happen, then fine, no problem. It's sort of making sure that they've thought through, what would happen should the unforeseeable happen, and that things are planned out in advance. I mean, the situation you gave where all three died in the same plane crash, I'm not sure there's a really great solution for that. But there certainly is, where one or one or two people can't get along, a mechanism for them to buy out the other partner, or vice versa, or if somebody deceases prematurely, to get bought out through life insurance proceeds or whatever. And there's a lot of care that needs to go into it in terms of, yes, you want to take care of the person's estate, you want to be able to buy out disgruntled employees who don't get along, but you also don't want to cash strap the company. And not everything's insurable. So there are certain circumstances where you may not be able to pay cash, and you may have to do other things like, pay part cash and part seller note. So there are a lot of things to think about. It's pretty complicated. LegalZoom is good for certain things, and this is probably not one of the categories where I would, every time I've seen one, I thought, well, this is, fine for a one owner company who it's really an agreement with themselves. But once you have two people in it, that approach seldom works.
Well, I'm really glad to know that, because you're bringing up a lot of topics that we'll be covering at our GovCon Summit, which is going to be virtual in April. And I'm so glad that Bassbury Sims is going to be a part of it, because you guys always bring that extra information that people need to be thinking about in terms of growth. It's one thing when you're in a startup node. It's another point where you're in an area that I call the traction section, when a company's from 10 to 50 employees. But once they start growing into the next stage, and actually I've identified 7 stages, they need to be thinking about, well, this is fine for where we are now, but every time we go up to the next level, we've got to look around and say, what else has changed? What do we have to be prepared for? And have our goals or our opportunities changed? So it's really been great to have you on today, Jason. If people wanted to get in touch with you and ask questions or have a conversation with you, how do they reach you?
Yeah, I can send a link to my profile on the website to the group in the chat room in a moment. But yeah, my email address is jnorthcutt@bassberry, and then I'll probably be easy if I just send the link in the chat room.
Well, I just usually tell people to call me, and I'll put them in contact, because that's the easiest thing to do. So anything else that we should add before we wrap it up today? Nope.
Unless there are questions.
No, I think we've covered it all. So again, I want to let everybody know that we've got GovCon Summit coming up, and you can register now. It's at solvability.com, GovCon Summit. Looking forward to really addressing some big issues that are affecting small businesses and federal contracting today.